Get ready for more valuable financial insights from Northern California's premier retirement income planners, Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
We'd like to welcome you to the Peak Financial Freedom Hour. My name is Dan Ahmad. I'm here with my partner, Jim Files. And we'd like to thank all the people that have listened to our show for years now, and our current clients who listen just to make sure they're staying up on the latest on what's going on in the marketplace and make sure that they feel comfortable that their plan is still on track. So thank you very much. We're really, really happy to be able to give you some advice. So if you've been listening for a while, take that step to meet with us. It's not going to cost you anything for us to give you a free second opinion. Just dial pound 250 on your cell phone and say the keyword money. That's pound 250 keyword money. And we can talk to you to find out, are there some things we might be able to help you with? And again, there's not going to be any cost or pressure with that type of meeting. You also can go to our podcast and listen to every radio show we've done. They are on the podcast on our website. You can go to our YouTube channel and you can actually watch us being filmed while we're doing the radio show right now and listen at the same time. You can watch our TV shows that are on our website, and you can download a tremendous amount of information, even including our most recent best-selling book on Amazon called Mama's Secret Recipe for Retirement Success. So make sure if you have any questions, dial pound 250 on your cell phone, say the keyword money, and we can help. And I say that because so many people, literally, the client that told me that she was listening to us for years and waking up at night and then finally watching the TV show, she finally called in because she's like, okay, I think I need help. That's 3 years of her not going without sleep. So it's like, oh my gosh, take that step. Just find out for free if we can help you. It's not going to cost you anything. Why don't you start, Jim, with a financial wisdom piece of the week?
Okay, this comes from Fred Rogers. He's a motivational speaker. Often when you think you're at the end of something, you're at the beginning of something else. And that applies to so many things right now in the market, the way you feel, your job. I mean, you could be working right now and it's going to end because you're going to retire. It's going to be something. It's going to be something different in the future. You could have money in the market, lost a lot of money in the last 4 or 5 weeks. It's into something mentally, you think. And what should you do at this point? You want to retire or in retirement and you think you have enough money, but you don't have a plan in place. So you have the opportunity to do something different. So this has to do with a lot of different choices you can make, because when something ends, it doesn't mean that it's going to continue at that pace. You can change your life and change your plan and change the structure of how you want your outcome to look like in the future by taking control of your life, control of your finances, and putting together a plan to make you feel comfortable about the future, Dan.
Well, I think what you just talked about kind of fits into what we're going to talk about today, in that you're looking here. The guy says, when you think you're at the end of something, you're at the beginning. Well, when you're working, you don't think the end of your work life is going to come. And then all of a sudden, out of nowhere, bam, it's like, oh my gosh, I'm 60, I'm 65. What do I do now? Oh, I guess I'm supposed to retire. When can I retire? Do I have enough saved? Am I going to run out? Can I live the retirement of my dreams? All those things we start thinking about, and work at some point will end. And it then states work then leads into retirement. Well, I always ask people, work, do you really want to retire? And the answer is we don't want to retire. I read an article. We want to rewire, not retire, but rewire. And that's why it fits in well with this guy's Fred Rogers statement, because you're at the beginning of something else. You have to rewire your entire life to get ready to live the next 20, 30 years into retirement by rewiring it and now creating a really, really wonderful financial base so that you now can live a really, really wonderful life, because the financial base and income is what's going to drive lifestyle.
And the difficult thing about thinking about retirement, if you're not retired right now, or if you're in early retirement, is how do you draw income off your assets? And how do you make sure that if you live 20, 30 years in retirement, that you're going to have enough income? So what happens is, if you don't have a structured plan that delineates all these income sources and what your after-tax income is and what your budget is and how much risk you have and how much you could lose, and knowing where your income is going to come from, is there going to be a deficit at 3 years downstream? What about inflation and how that's going to impact your income? What if you or your spouse need long-term care? What's that going to do to your asset base? Unless you have that in writing, I don't see how anybody can comfortably retire. And what most firms do is they're going to tell you you're going to be just fine because you have enough assets. But what does that really mean? It doesn't mean anything at all. What it means is that they don't and they haven't put together a plan for you, because unless you can get answers to these questions, Dan, I don't know how anybody can retire successfully. I'd be a nervous wreck.
Well, if an advisor tells you, well, you have $3 million, $4 million of assets, you'll be fine. Well, you'll be fine 100% guaranteed if you don't ever need to use those assets for income, because at that point, you're fine.
Yep.
But as you talk about in a lot of those shows, people just don't get big pensions anymore. And if you don't get pensions, you want big pensions. So at that point, when an advisor at these big brokerage firms, it kills me. They are in asset accumulation mode, and they're trying to give advice to people that are retiring or already retired or planning to retire. And they're trying to give retirement income planning advice, but they're giving them asset accumulation advice saying, oh yeah, you need to stay aggressive investing. It's the only way you're going to make it. Well, think about it. If the stock market goes down 39% every 5 years, like it did since 1929 until now, and that happens again for the next 30 years, what's the chance you can leave your money invested for growth and have the money last forever while you're drawing a significant amount of income off of it to live the lifestyle you planned while you're going through these 39% losses every 5 years?
Well, I'll give you a good example. I had a client come in late last week, and they had $3 million in assets, and 99% of that's in the market. They had very small amount of money in the bank, maybe $30,000. And over the last 3 weeks, they've lost 11% of the value of the portfolio. They were invested in lots of stocks. So 11% of $3 million is about $330,000, right? Well, their plan, which they thought was a plan, their broker had them taking out 4% in income off those $3 million for the rest of their life, which is $120,000 a year. So imagine how these people felt when they came in. They talked to me and said, we're supposed to take out $120,000 a year, which is a 4% distribution off our $3 million, but we just lost $330,000 in 3 weeks. What do we do? And that is disturbing, right? Because what do they do at this point? Because if the market continues to go down, which it can, the market will go up and it will go down. But if we actually enter a period of time where we are going to theoretically go into a recession, this market isn't done with going down. And if that happens, that means that person, if they lose another 10%, now they're down another $300,000, right? And they're still taking out $120,000 a year. I think you get the point here to see how fast your money could run out. And whatever that broker's comment was, where put all your money in the market and you'll be fine. I don't know about this client, Dan.
Well, the 4% they're taking out even just to start, that's going to be a little high when you're looking at that being based on a volatile asset. If it's not a volatile asset, then that might work. But if it's a volatile asset and you take 4% out, now just because of taking the income out and the loss, they actually are taking a 5% distribution, just in the example you gave.
Yep.
If it happens again, like you said, and that's just based on a 10% loss, one more 10% loss, which just basically puts us in a bear market, which happens every 5 years, that then requires them to take out 6% while they're trying to recover. What's the chance if they're taking out 6% of their base at that point, because it's gone down probably almost $1 million? What's the chance they can take out 6% and then recover?
I don't know how they can recover. And I know how nervous they'll be. And I know what they'll do. They'll stop spending money if they can't stop spending money. Some people can't stop because you have a certain budget. So it is scary. When the market's going up, everything's fine. You don't have to worry about anything. Yeah, I'm making money and there's no issue. But when the market's going down, and it will always go down and it will always go up, and you're drawing income, which you weren't drawing income when you were working, you didn't have to worry about it. You could stay the course, making contributions with your 401k. You didn't have to worry about it. But now, all of a sudden, when we start to go into a correction or even a bear market, and you're drawing income off those assets, it's a different world, a completely different world.
Well, and I think when you look at what's going on right now for everyone out there, it's the uncertainty that is causing everyone to worry. And you try to look at the United States as a whole and just think about how many people really right now in the United States feel like they're in control of their money. And very, very, very few feel like they're in control of their money because they think they have to watch their assets go up and down dramatically in the stock market just to get into a position to be better off. Well, if you look at what's happened to your money over the last 5-10 years, did you really increase your value of your assets significantly over that time period? And from the growth, the answer is probably no, unless you were just invested in Bitcoin and got lucky, or in NVIDIA and got lucky and got out before it went down, or Tesla before, it crashed, all those things. But most people look back and they go, gosh, it seems like if I was working, the biggest gains I have were for my own contributions. And if I wasn't working then or making contributions, it doesn't look like I've actually grown much at all. Have you seen that?
Well, a lot of people have seen that because you look at 2018 and 2019, there was a tariff scare back then, the market went down. Then we had COVID in 2020, the market dropped precipitously. Then in 2022, the market dropped 22%, the NASDAQ was down 35%. Then in 2023 and 24, it came back up, but it took almost 3 years between 2022 and 2024 just to get back to even. So yes, that's true. It's been very difficult, even though when you look at the barometer, the S&P and the NASDAQ, if you look at it a very specific time period for the last 15 months, yeah, it went up, except for the last 3 weeks. But if you look at over the long term, 6, 8, 9 years, it's been a tough ride in the market, Dan. It just has been.
Well, you look at the last 15-year time periods in the S&P 500 index, and you look at the index itself, which is what you're always getting data on, whether it's on the news that you watch, the radio that you listen to, the internet that you search. They talk about the S&P 500 index, meaning the largest 500 companies in the United States grouped together as if it was one asset. Well, if you go back and look at the last 15-year time periods, and they always tell you, oh, invest this way, you have a lot of growth potential, which you do, but you also had 2 time periods where the market dropped more than 50%. The average increase per year for every one of those 15 years is 5.99% before fees, before taxes, and before income distributions. So if that's true, which it's 100% accurate, 5.99% is the increase per year before fees, taxes, and any income distributions. How will that then allow someone to succeed based on how much risk that's being taken in the market right now? You're back with Dan Ahmad and Jim Files, Peak Financial Freedom Hour, and we're going to talk about right now what is actually called the lost decade, but that's really not the true name for it because it's actually the lost 13 years. Everyone always talks about the lost decade being 2000 to 2009, Jim, but it's like they stopped looking in 2009 and thought, okay, everything's fine. Well, you go back to 2000, January 3rd, 2000, when the stock market, I believe, was at like 1452, 1462, somewhere in there. And you look at 13 years down the road, January 2013, then the S&P was like, I think at 1459. So if it started at 1462, ended at 1459, 13 years later, how much did the market go up by?
None. Zero. Nothing. And if you paid fees, you paid taxes, if you took out distributions, your account went down in value.
So does that mean there was a lost 13-year time period?
Yeah, there was. It was a loss of your potential to make money, presuming you took no money out of it, right? And yes, a lot of you were working during that time period, and you said, well, that's not true. My account value went up. Well, it probably did because you were making contributions to your own retirement plan. It wasn't because you beat the market, because most people can't even beat the market. They can't even get close to getting market rates of return. So that is market data there. 13 years, if you look backwards, you made no money. And can that happen in the future? Of course it can. If you look at the volatility we're experiencing right now in the market and the unpredictability that we are all facing with the world, with tariffs, with other things that are being discussed right now, we have an opportunity to, I guess, theoretically come out of this in a reasonably good shape, but we don't believe it's going to happen quickly. I mean, there's too much uncertainty, and what the market doesn't like is uncertainty. The market doesn't like the fact that the future is unpredictable, and that's why the market has so much volatility. And by the way, you and I do not control the market. It is the institutional traders on Wall Street that control the market. They have the trillions of dollars, so they move this market. And if they're unsettled because of the unpredictability of the market, they move this market up or they'll move this market down, and there's nothing the consumers can do about that, Dan.
Well, the goal is to try to avoid that next lost decade or next lost 13 years. And we say that because we know it will happen at some point in the future. We're just not sure when, because it's happened before. So if it's happened before, we have to have the attitude that it can happen again, especially based on what we always talk about. The stock market itself since 1929 has gone down an average of 39% every 5 years. So we have to plan on that. Well, let's say we were looking at the time period from January 2000 all the way through January 2013. And the S&P 500 index was flat during the time period. But you say, gosh, my account grew. Well, if you put in your maximum contributions to your 401k, you probably added $300,000 of deposits. So your accounts might have went up by $300,000, and they probably did because you're a good saver. But Did your accounts grow because of the growth in the market or because you're a good saver in additional deposits? And it's kind of what you thought. You kind of had a sneaking suspicion that the only growth you were getting in your accounts was from your own deposits.
Yeah. And a lot of people, when we actually go through this exercise with them and we show them the data, they start to nod their heads. And that's what I thought. I really figured, how could the market have lost money for those 13 years, up, down, up, down, up, down, and my account went up in value because you were making contributions to it, right? So it's different, though, when you're retired because you're not making contributions to your account. And if that market is flat for 13 years and you're taking out 4 or 5% in an income distribution every year, your chances of leaving a long retirement happily and securely are going to vanish very quickly. It doesn't mean that we don't believe in the stock market. We do believe in the stock market long-term for certain assets, but we surely would never recommend a client put all their money in the stock market. We're dividing money up into different asset classes that are behaving completely different than each other so that we have the opportunity to have enough income for our clients to do the things they need to do in retirement so that they can have fun and accomplish those dreams that you've thought about when you were working. You can still have money in the stock market, but you have to be weighted correctly because we know what happens with the stock market. It goes up and it goes down, and there's no length of time. There's no way anybody can predict how long it will take to come back if it does go down, Dan.
Well, exactly what you're talking about leads people to trying to find a way to figure out how do they protect their savings and therefore protect their sanity.
Yeah.
Right. That's what it comes down to. How do you stop worrying about the money so much? And it always comes down to what we talk about, and that is reducing the amount of risk in your total portfolio. Some of the assets can still have risk and have significant volatility, but you want a large chunk of your assets not to have any risk and volatility. And the blended overall risk ends up being something you can fathom. Right now, you might have a 40% risk in your portfolio. When we say that, people are like, well, what does that mean? What it means is, let's say you had $2 million in your portfolio and we go through another 2008 financial crisis type loss. You better be planned to lose 40% or 800,000 or 2 million. And if you're in retirement or getting ready to retire, how many people are really willing to lose that much money? And the answer is zero. It's just they didn't know it, or they didn't know that that would have this huge repercussion to their success for retirement. So number one is to make sure we reduce risk down to a level where it's not going to hurt us. The second is make sure we create income that will never run out for as long as we live, because that's our next fear, is running out of income. The third is to make sure we have a high level of income that's guaranteed forever that will allow us to have more money than we want on a monthly basis and need, so that we can save money and also keep pace with inflation.
Yeah, I mean, you're talking about risk and drawdowns in a portfolio. And if you're looking at income requirements, you have to make sure that, as Dan just mentioned, that you have enough predictable, dependable income coming in for as long as you live. And that comes from a variety of sources. That's your Social Security income, right? That is, if you have a pension, that income. Maybe you have real estate that's completely paid off and you have rental income and you maintain those houses so that you don't have a big expense coming up. Well, there's another source, which is we use often. It's a guaranteed income source that will give you predictable, dependable income for as long as you live at a very, very high payout rate. It's like your own little pension that you built yourself. And when we combined those income sources, that's your guaranteed income. And then we can invest money in the market, and then we can take risk in the market. If the market goes down, it's not going to affect our income. We can kind of write it out, I guess, in that example, right? And the goal is to make sure that we've structured the portfolio correctly on the front end.
You're back with Ahmad and Jim Files, the Peak Financial Freedom Hour. And today we're talking about how to help people stop worrying about their money so much. We know everyone's going to worry about their money one way or another, but how do you help them stop worrying about the money so much? So let's talk about one thing that's on minds of a lot of people now, and that's inflation. And we know things typically will always increase in cost over time. It just happens. And one of our TV segments, we call it one of the silent thieves as far as what's happening with inflation, because you don't even see it. Just every time you go to the gas station or the store, everything costs more. And basically, when things cost more, that's the definition of inflation. So you have to make sure you have enough income to pay for these things. And we find the typical advice that consumers, especially retirees, are given on how to fight inflation is exactly opposite of what they should do to be able to fight and conquer inflation. Number one, it's always been said you need to invest in growth-oriented assets to beat inflation. Well, the issue is they're talking about something that if it does grow every year, of course that philosophy works. But in a growth-oriented asset, the definition of a growth-oriented asset means it has volatility and potential for significant principal loss. So what if you're trying to combat inflation, Jim, and you have your assets in all growth-oriented portfolio? Like we saw a client with $4 million of all stocks and stock mutual funds, maybe a little bit of bond, maybe a little bit of cash, but really growth. And they had a lot of risk in the portfolio. And they've been told by their advisor, the way we're going to make sure nothing bad happens to you over your next 30 years of retirement at age 60 is to be growth. Well, what happens if this portfolio, and we did an analysis that showed it could lose 50% of the $4 million if we go through another 08 financial crisis when the S&P 500 dropped 50%. And that's just considered a moderate portfolio. What happens to this person's ability to be able to keep pace and combat inflation if they have 50% less assets in the portfolio?
Forget it. Forget about inflation. Forget about their income sources. Forget about the retirement they dreamed about. Because if you lose 40 or 50% of your money and you're using those assets for income and you have no other source of income other than Social Security, your life is going to change completely. That is why we don't believe in putting all the assets into the market. We don't do that here. We divide the money up into different buckets that do different things to make sure that we have enough income lined up in the portfolio design to make sure, knowing that the market is going to drop. I mean, you can use any system in the world. We have some really cool stuff that we use here, but we can't stop the market from dropping. We can't stop you from losing money in the market. It's absolutely impossible. That is why we don't put all the money in the market. We divide the money up. And for example, you mentioned that 50% loss factor. I want to make sure that the listeners understand what risk is. If you have a balanced portfolio, 60% stock funds or equity, stocks, right? And 40% bond funds or bonds, you have a risk factor of 38.53%, which means if the market drops by about 50%, you're going to lose a little bit less than 40%. I know you don't want to believe that, but that is the data. That is it. If you go back to 2022, a balance index at any one of the major mutual fund companies made up of 60% equities and 40% bonds was down over 20%, about the same that the S&P was down. So you have to understand that if you don't comprehend the risk you have in your portfolio now, it's too late when the market starts going down.
Well, basically what we're saying there is when you look at inflation, if you invest in growth-oriented assets, everything's great if the market goes up, but we know the market will go down. So we think the best way to protect against inflation is to invest in lower risk assets that will not allow you to lose as much principal, so we don't have to recover as much. And the lower risk types of assets will typically allow us to take more income out. And income is the only thing that will combat inflation. It's not growth. It's not the value of your portfolio. It's the income you're deriving from those assets. And you kind of alluded to the next step, which people talk about, which we don't agree with. And that's like, they say diversify across asset classes. Well, we believe in diversifying across our three buckets, but when you're told to diversify across asset classes, it's just what you talked about. They say you need 60% in stocks or stock mutual funds and 40% are bonds or bond mutual funds, and they think you've diversified between these asset classes. Well, maybe if you're 25 or 30, that works, but in retirement, if you've now put your money into that type of portfolio, which is what they recommend for a 60-year-old, 60% stocks, 40% bonds, and we have another 2022 and you lose 20 to 25%, what's the chance if you're taking a big amount of income that your money's going to last?
It's likely not going to last. I'm not saying it's not going to last. You're just going to have to cut your budget down.
No, but what if they don't cut their budget down? What if they don't?
Then it probably won't last. That won't last. And that's only a comparison to 2022. If you go back to 2007, 8, 9, or 2001, 2, and 3, where the market went down over 50%, those 60-40 portfolios were down 35 to 40%. And that's a big hit.
38.49 is the average.
Yeah.
So it's very tough then. So when you say diversify across asset classes, we agree by amending that statement, diversify across using different buckets that actually act differently than each other. Because if you have a stock mutual fund and a bond mutual fund, you are told to invest in these because they act differently than each other. They're diversified. But in 2022, Jim, you just pointed out both stocks and bonds went down together. So were they diversified?
Nope.
There's no diversification. They acted the same. We're going to use three buckets as we start putting plans together. And three buckets are going to be our gold bucket, which is going to include cash. We want our clients to have some money in cash. In fact, we won't put a plan together unless we have bucket in the money in the gold bucket, which is cash. We think that's prudent. Well, advisors don't like to tell you to put money in the gold bucket because they don't get paid to do so. We're going to be acting as a fiduciary for every one of our advisory clients. We're going to be acting myself as a certified financial planner. So it's prudent to then have money in the bank. The second then is we're going to have money most likely in the growth bucket because we still want growth. We just don't want too much risk inside of that. And we want to reduce how much we could potentially lose if the market crashes. So it's not that we have no losses. We just want to reduce the large losses. Then we're also going to use our green bucket. And our green bucket is the principal protection guaranteed lifetime income bucket that allows us now to get the highest level of income we can find that's going to be paid to you for as long as you live, whether you're single or married. For example, you're 66 and you wanted to take income out of this plan and you wanted to defer your income just for 3 years, we could pull out over 10% guaranteed income off of your investment for as long as you live, regardless of what happens in the marketplace. It starts to make you see that things can work out if you make the right decisions. You're back with Dan Ahmad, Jim Files, the Peak Financial Freedom Hour. And today we're talking about what you should focus on to help reduce how much you're worrying about your money and to help increase the chance you're going to have a successful retirement. And we're talking about inflation right now in this segment. And we're talking about how with the basic type of advice you get from the traditional financial industry out about inflation, we just don't believe in it because we don't think it's going to happen. Number one thing that you're always going to be told by the traditional financial industry is to always invest in growth-oriented assets. Go for growth. Well, when you're 25, 30, 35, 40, 45, yes. The problem is now if you're in retirement and you're trying to beat inflation by investing in growth assets, that means you're putting your assets at risk. You're putting your assets at risk of principal loss. And if you have significant principal losses, it's almost virtually guaranteed you will not be able to keep pace with inflation. So that really doesn't work in my mind. The second is they say diversify across asset classes, namely certain percentage in stocks and bonds. Well, stocks and bonds typically have worked opposite of each other, providing diversification. But now we're in a world where if you go back just to 2022, stocks and bonds went down together. So there was no diversification. We talked about how we want to then make sure we're going to have a balanced plan by using our 3 buckets: gold bucket for liquidity, red bucket for growth, green bucket for principal guarantees and lifetime income guarantees at a very high level. Well, how about let's look at then what it really comes down to in planning for inflation. So let's say someone had a budget of $10,000. We need to create a plan that'll give them $10,000 of net income per month after taxes. But if we just did that, their plan really is going to be tight because now we're just giving them what they need to spend. We want to build a plan that gives them 13, 14, 15,000 or more of net income after taxes. And we succeed with probably 90% of our clients to build $3,000 or more of net excess monthly income in it, I'd guess about 90% or more. So imagine your budget being 10,000 and you're not even generating that right now from income. What if we can generate 13,000 of net after-tax income by designing an actual plan for you? So you have $3,000 more to spend net after taxes after you paid your budget. How would that then make you feel? And what will that allow you now to do in your life?
Well, the goal in retirement, right, is to do those things that you dreamed about when you weren't retired. And the only way you can do that is besides maintaining your budget, that's one component. But how do you generate excess cash flow on an after-tax basis above your budget? Because that excess cash flow is going to allow you to do those things that you dreamed about, right? You may wake up in March and decide that you want to go to Hawaii for a week. Well, if you don't have excess cash flow in your budget already planned out, you're not going to go to Hawaii for a week, or you're going to draw down your assets much quicker than you had anticipated. So knowing on the front end that things will come up, not only just vacation, but you may need a new car. You may need new tires on your car. Things come up. You might want to help out your grandkids with their braces or maybe college education. You want excess cash flow above your budget. And most people don't know how to generate that. They're looking at their portfolio and say, okay, I have $1 million. My broker said I could take out 4% per year. That's $40,000 a year I can take out. That's it, right? And that's no guarantee. You take out $40,000 a year and the market goes down by 20 or 30%, you're never going to recover more than likely, and you're going to draw down your portfolio. So you have to design a portfolio with asset classes that behave differently in that you have income guaranteed as a portion of your portfolio, and we can generate enough excess cash flow to maintain what you want to do in retirement.
Well, Jim, what you're talking about is very simple. Think about it. As you're driving around or if you're sitting in your house or at your office right now, do you want to take a portion of your assets and say, I want to guarantee I'll never suffer a stock market loss on this portion of my assets? And every single person will say yes. Then in the same question, do you want to guarantee you can receive income off of those assets guaranteed for as long as you live. Even if you live past 100, no matter what the stock market does, goes up or down, you're going to always get this income, even if your assets run out. Do you want to use a portion of your assets to do that? Every single person is going to say yes. And in the same question, do you want to now create some of the highest level of income payouts you can get out of any asset right now, up to 10, 11, even 12% payouts of your original investment, depending on how long you defer and take the income out? Would you like to use a certain amount of your assets to put in that bucket to give you those things? And the answer is yes. It's just no one has ever offered you these things or explained it in this way, but it is one of the key components we see allowing people just like you, retirees or soon to be retirees, to build a successful, not just successful, but an extremely successful, enjoyable retirement where they don't have to worry as much. And when you look at what you talked about earlier, the spending money, one of the issues I see, if someone isn't creating a lot of income, they might feel guilty. They might still take that trip to Hawaii, but they're on their trip to Hawaii and they feel guilty that they spent the money, and can they enjoy it as much then?
Well, not only guilty, they start worrying about that they spent the money, right? They're worried that I shouldn't have spent the money. I'm over here. I'm not having a good time because I should not have done this. It sounded good at the time, but I realize now I'm drawing my portfolio down faster than I had anticipated. The market dropped by 5, 10, 15%. And am I going to be able to get through retirement? So you start worrying.
What happens if they're on the vacation or on the beach and all of a sudden they're trying to tune out all the noise? They hear the radio that says the stock market just gone down 10%. How are they feeling then sitting on the beach?
Well, that happened the last 2.5 weeks, right? The S&P dropped 10.1%. The NASDAQ dropped almost 15%. And if you owned individual stocks, you might be down 10, 12, 15, 20, or 30%. So yeah, that stuff happens. That is the stock market. So you have to make sure, and again, you're not taught this. We're teaching you this. We're trying to educate you on how to develop a portfolio with 3 different buckets that behave differently. The first bucket, the yellow bucket that Dan mentioned, is the cash bucket. There's no market risk. That's CDs, treasury bills, and cash. You'll manage that. We'll tell you where to go to get the highest rates of return, but it's safe and secure, and you can use it if you need it. The second bucket is the growth bucket. We believe in the stock market, but we know the market's going to go up and down. We don't want all the money allocated there, and we're going to put in position stop loss technology to help defer some of the losses. You can't get rid of the losses, but we're trying to defer a major crash. And number 3, then we want to look at the guarantee bucket. How much money do you want guaranteed for the rest of your life? How much income do you need guaranteed in your budget for the rest of your life? We drop enough money in that bucket to do that. So when you're on the beach in Hawaii, your income is taken care of between Social Security, maybe your pension, and your guaranteed bucket. And if the market go down, well, bummer, it is going to go down and it's going to go up. It's not going to change your lifestyle if structured correctly.
Well, when you're on the beach in Hawaii, think about it. Do you want to be worrying about the stock market crashing, or do you want to be planning your next trip back to Hawaii, maybe a different island? That's the difference of having a plan and not having a plan.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.